Hey, good afternoon, everybody. It's mid-July. We're in the middle of summer, very hot summer here after a very cool, wet spring for our July market insights. Before we get into the meat and potatoes, let's hear from the compliance folks.
Hey, Todd.
Okay. Hey guys, Gavin,
Hey,
Rich,
Todd.
how's everybody doing today?
Good. How about
Boy,
you?
lots gone on since last time. We had this big, beautiful bill, and we'll talk a little bit about that. But before we get into new stuff, let's just kind of recap our what's happened from our June meeting into now into July.
Yeah, sure. For a while, we've seen this potential for a risk-on kind of phase in the markets, and as July begins, we've seen that continue. We're in a risk-on environment, meaning that's what the market pricing across all the markets we look at is indicating. I think Rich will maybe dive in a little bit more on that. But really, that's the pickup from last time is just that risk-on environment, and we'll see how long that continues.
Yeah, I think if you go back maybe a couple sessions ago, we thought that by now we might be seeing, quad three inflation with growth slowing, inflation reaccelerating. That got interrupted by the fact that Wall Street took their estimates down too sharply in response to Liberation Day. And from there, they've been revising their estimates back up. So the economic data has actually beaten Wall Street expectations. And that revision higher in growth expectations has created kind of a quad one acceleration. So the economy hasn't been accelerating, but to Wall Street, growth looks like it's accelerating simply because they've taken their numbers down. So that's provided some fuel for a risk-on environment. And, it does look like it, has the ability to sustain at least until next month. But when we reconnect next month, we'll have an update on that.
Good. That's great. It is. It's been something. A lot has gone on, since the new administration's taken place. We've had tariff conversation. We've had markets that have been very volatile, both equities and bonds. But since our last meeting, we got the passage of the big, beautiful bill, which I think that's what it's called. It's a mouthful. But I think clients would probably like to know, not so much for this session that on the planning side and how do we tax prepare. That's more of our financial planning side. This is the investment team. So how do you see this bill impacting markets or the pros, the cons? How do you forecast, what the new bill, what's in store for markets here as this unfolds?
I would score it overall as a modest positive. And maybe before we get into the details of it, if we step back, there's one thing and one thing only that generates economic growth, and that's business investment. Every dollar of business investment generates 45 cents of GDP forever. So in looking at this bill or any other bill, the question would be what changes at the margin make business investment more attractive? What increases the after-tax return on business investment? What lowers the cost of business investment? And ideally, you would have those kind of incentives coupled with an incentive for individuals to save. So when individuals save, that creates capital. Businesses then use that to convert liquid financial capital into illiquid physical capital. The only thing that stands out would be the expensing of business investment that was part of the original TCJA. Then it hit a phase-out period. And at the very least, they've restored that to make it permanent, where you have 100% business expensing, investment expensing. So that's a positive. but that's really the only positive. You know, the no tax on tips is nice, but it's not going to change business investment. The no tax on the lighter tax burden on Social Security is nice, but it's not going to change business investment. And there's really very little to give individuals an incentive to save more. They have those so-called Trump accounts that are going to be, you know, for newborns. Conceptually, it's a great idea. You know, everybody should have the ability to put money away, you know, tax-free. So anything that happens at the margin to create more savings on the individual side is good. Anything that makes it more attractive for businesses to invest is good. So overall, I would score it as a slight positive because we've already had that in effect. We just hit the phase out, and now we're going back to full expensing. So it's you know, marginally better for economic growth.
Good. Kevin, any input or anything to add on to what Rich had to say?
Yeah, I guess maybe the interesting point, and Rich probably has some thoughts on this too, if I had to guess. But it's a good reminder of, you know, ESG investing was all the rage for years. And we at Park Edge always saw it as a bit of a fad. And not that we don't think some of that technology has merits or pros and cons can be debated, but just the idea of how it was being marketed to the public. And we didn't agree. And so here's a good, you know, reminder that when investing, you know, in something comes into vogue because of tax credits or something like that, that could be taken away. And that's what we saw with this bill. And then, you know, here we are. So I think investments like that could see a lot of headwinds moving forward. And Rich, do you have anything? I know we've talked about
You know,
it.
I would just kind of, you know, connect it to the broader, you know, picture. So at the margin, there are slightly better incentives for businesses to invest from a tax standpoint, but they're still dealing with tariff uncertainty. We really haven't seen the kind of deregulation, you know, that was part of the campaign. So there's one part of the tax bill that made it incrementally more attractive for business to invest, but there are other things that may be holding them back, you know, from doing so. So if you look at the economy in the broadest possible scope, gross output is a better measure than GDP. GDP is final sales. Gross output is twice GDP. So there's a lot of economic activity that takes place that just does not register in GDP yet. So gross output would be the area that we would look to see our businesses getting plans off the drawing board and enacted. You know, are they starting things in motion, you know, to break ground? You know, and to the extent that we see a pickup there, then maybe we would be more prepared to say, you know, now GDP is poised for a sustained pickup in growth. So slight positive from the tax bill, other reasons that might balance that out before businesses get, you know, aggressive about investing. And, you know, something we're tracking closely because I think that would be a key turning point for investors is to see a pickup of business investment.
Well, that's good. That's good insight, good input. And, you know, I think today's a shorter session. I think that covers what people want to know. Over the next 30 days, a lot going on with the Fed. I think the Jackson Hole meeting coming up. So there'll probably be some things that come out of that are going to be, you know, top of mind to discuss here in the next in the next coming months. So with that, I think that should wrap it up. Appreciate it, guys, and we'll huddle up in mid-August.
All right, sounds good, Todd.
See ya.
Thanks, guys. Have a good day.